Welcome to TMS Insights. It's just through the reporting season of August and we've started September. So it's Jeremy and Ben again bringing you updates in still the COVID lockdown situation. But Ben, COVID's been a thematic through the reporting season overall for positive and negatives of companies. And we really think, having heard so many of these reports, that it will be an ongoing feature.
Yeah, I mean, you kind of get sick of hearing about it, don't you? Because it just gets drummed into you every day that, you know, it's not going away. But just countless examples of it, Jeremy. And, you know, saying to some clients earlier, like there's some businesses, you know, issues that you'd never even thought of. There's some benefits that you'd never even thought of. There's challenges. It's affecting everyone. And it's kind of not just what's going on now. It's like what the recovery out of it looks like. And there's a lot of uncertainty, of course, and it's not just here, it's everywhere in the world. You know, a lot of Australian businesses operate all over the globe, and you know, they're experiencing different things in different places. I think if I picked out one key thematic, was what it's done to supply chains globally, and that is causing headaches for everyone, you know, even companies you wouldn't expect.
And we didn't want to labour the COVID point with everybody who's pretty much sick of it, I guess, but it is so important. And if we talked about Altium and we saw how it was affecting the supply chains there, which, you know, things beyond their control in many cases, and yet on something like event hospitality, which is its operations are affected, but they weren't affected that much. We were surprised, and the asset values of their properties have actually gone up. That's what a dichotomy it is.
It's bizarre because, of course, COVID has created trapped capital, record low interest rates, and that has created asset prices to rise, which is also positively impacting. And, you know, we saw like a company like Goodman Group as an example, you know, the demand that has gone through the roof for logistics properties, not just price-wise, but also because of the knock-on effect of, you know, everyone ordering things from home and every single business now needing to get online and therefore to have distribution centres close to population centres. It's incredible. So, you know, it's kind of a tough time for most clients watching this, and I'm sure we're all just looking forward to getting out of it. But it does feel like we've got at least a year or two where we'll be listening to companies talking about the challenges and the opportunities for them from it.
Yeah, so it's unavoidable. Getting into those stocks, we mentioned Altium. You know, it's doing as well as could be expected. The share price reaction was certainly a bit of selling, but you know, after a year with the takeover plays and everything, they've become good value again, Ben.
Yeah, I think so. Look, the only real negative out of their result, there was a bit of an unusual part that the numbers hadn't been signed off by an auditor at this stage. Another COVID knock-on effect. There's a shortage of global auditors, go figure. But they did push out their 2025 targets to 2026. You know, effectively had a lost year last year. But, you know, also spoke about the move to the cloud and what Altium 365 is going to bring to the electronics industry globally. So, you know, there's some opportunities. Like it's a weird market, Jeremy, where the market's at all-time highs and it keeps pushing higher, but there's plenty of stocks that are out of favour at the moment and plenty of good businesses, I think. And it's because, again, of COVID.
Yeah, and I'll just furnish a point there you made about record highs. The actual index has come down a bit, but dividends have come out. And so there's been some massive dividends. We're recording this on Thursday, and we saw BHP and Woolworths go ex-dividend today, and you know, Fortescue's in a couple of days. There's some mega dividends that are coming out. So the accumulation index is right up there, even if the gross index is a little bit off its highs. But you're absolutely right, Ben. You know, a company that we've mentioned before, Nanosonics, was an interesting one because it was surprisingly good. We knew in the first half of the year that elective surgeries and hospital entries, which were mixed and lower overall, impacted, but they had a really good second half.
Yeah, incredible. And that was, you know, hospitals, particularly in Europe and their key market is the US, were closed to anyone that was not a vital patient effectively or working in the hospital. So they couldn't get their sales staff into the hospitals. The things that their products are used on, which are generally elective surgery, is completely cancelled. You know, but what they showed was that there's this backlog of demand that needed to be filled. And as the hospitals reopened, it feels like the industry is looking at things a bit differently and open to doing things differently. Is one takeout. And that was another one. If I could call out another trend, like Invacare, I think would fall into the same category there, Jeremy, where we're actually expecting a pretty poor result given what's going on with funerals and funeral homes at the moment and the lack of people being allowed to go to a funeral. But what they have done is they've taken a lot of cost out of the business during this downtime. And although the result was nothing, to really write home about, what the market looked at and could see was that the cost base has really been worked on. And when we do get that revenue pickup come through, the profit surge is going to be a lot stronger than expected. And there's things like that with many other businesses that we saw as well.
The other one I picked up on Invacare was really how that prepaid business had done very well, because we've argued this for a while that was a funds under management business by default. And I think they recorded about $39 million profit on that in the half, which was massive, and it's quite material for them. So it's amazing how they're not exactly what you think when you look at a business like that and you look, there's nobody going to funerals. But even using platforms like we're using today, such as Zoom, to distribute those services to a wider audience is a sales opportunity. So pivoted on that front. I was going to mention Seek, really interesting how they're moving into this early stage ventures. Ben also comments on Challenger, whose result was better than it had been in previous reporting periods.
Yeah, I thought Challengers was another surprising highlight, and that might be because interest rate, bond yields have started to turn higher because of all the knock-on effect of the Royal Commission has slowly died down. And also, advisors were able to get back in offices and see clients again in the last half, which, they weren't able to do previously. Of course, there's a big global player here who raided the register, buying Caledonia's stake at a 10% premium to the share price. So I think there's, I'd actually be surprised if Challenger's still on the market in a year or two. I think that they're genuinely looking at taking it out. But nonetheless, I think the highlight for Challenger was in the funds management business. It was in the Fidante business, which is kind of a similar business to Pinnacle, which saw like 17% funds growth in 6 months. So, again, it's like, that the business is transforming and it doesn't look anything like it did 2 or 3 years ago. And the good CEOs can do that. If they run into an obstacle, they can look for other opportunities. It can take time sometimes, but if you're backing the right people, hopefully, not always, but hopefully they can get it right.
Yeah, exactly. Going to the big Wesfarmers, obviously Bunnings predominantly there, and maybe Woolworths as well. We heard from Coles earlier in the reporting season, but some very good numbers from big companies listed in the top 20 there, Ben.
Yeah, and again, we've wanting to wax lyrical. The reason the market is continuing to be strong is because the big 20 companies in this country are doing well at the moment, and Woolies and Wesfarmers, both ripping results really, and very well managed. I mean, I think you got to call out Wesfarmers, which when you add back the Coles holding that they spun off, the special dividends that they've paid out on top of that, it's just been an extraordinary 5 to 10 years. And again, it's another business that's reinvented itself, Jeremy.
Yeah, it is. Yeah. Wesfarmers, just for everybody's, might have been missed there, they're giving a $2 capital return at the end of the year as well. They've just got surplus capital, basically. So it's another way to do it. Talking about a company doing well, and what a reaction post-result was WiseTech, Ben. That had a big move up.
Yeah, that was, for me, it was probably the highlight of the earnings season. It was a fairly amazing move in the share price, but it's so often been downplayed as, sort of expensive, et cetera. But, the business has executed, I think, incredibly well. And it's like every single metric just went in the right direction for them. They're actually aggressively taking cost out of the business while having a record 6 months of customer signups. But the big news was the what had happened post June 30, which was that they signed up FedEx, the largest logistics and freight forwarding company globally, onto CargoWise, which will pull countless more logistics businesses onto the platform who do the infill for FedEx. And to me, it's like a watershed moment for this company. They're now becoming the platform that every parcel is being tracked through, and they've just executed incredibly well. It's one of the true, sort of globally meaningful tech businesses that we've got on our exchange. And, again, doesn't look cheap, but it never has. And I would say, WiseTech, was heavily out of favor a couple of years ago. The share price dropped by, I reckon, about 60%, something like that. It is common for these businesses to do that. If you look at Afterpay, if you look at Altium, if you look at Xero, they have regular, quite big drawbacks, downs in price. And it's kind of part and parcel, unfortunately, investing in these kind of hyper growth businesses is you get real erratic share prices along the journey higher. And, it's something that you really need to be able to stomach.
Yeah, exactly. Pixar is a really interesting company. We've been waiting for it to list. This was the first time they've reported as a listed company, and their 42% shareholder Link, whose reaction post-result wasn't that great. Pixar's numbers were good. They're certainly demonstrating growth. They look like maybe a bit of a value opportunity, about $1 below IPO, Ben.
Yeah, I think, a lot of people might not be aware of what Pixar does. It's like Macquarie and the banks put it together to digitize property settlement around the country. It's, I think, becoming one of the stellar sort of growth stocks. However, it does have a big urge to move over into the UK and try and roll out what it's done in Australia into the UK. And with that will come some pretty significant investment. And, there's some uncertainty as to will they be able to do what they've achieved here. But even if you strip that out, incredible result. Like the margins that they've got and the profit that is now being spat out of this business is quite incredible. Link was disappointing, I'd have to say. They haven't done as well as the Pixar holding that they should have for their shareholders. And, they've sort of indicated that they're going to invest most of the revenue back into themselves. They look cheap, but they haven't really delivered. So, we've often said, Jeremy, I think, when we talk about REA as an example, everyone's always said buy News Corp. You get REA much cheaper than if you just buy REA. It's always been the wrong idea. You've been better sticking with REA because News Corp owns some pretty average businesses as well, like Foxtel. It's one that we're definitely going to have a look at in September.
Yeah, exactly. Ben, we'll come back and finish with some thoughts about the market and maybe overseas stocks as well. But just from a client's point of view, next week, just a bit of an alert. You'll see an email from us just giving you a warning that those who use Accolade service, so many of our clients do, will be getting new password details and new log-on details as a new interface is been updated. So stay tuned. You'll be receiving an email from us early next week, and you'll need to action that so you can get access to your portfolio. You'll be also given a text message with a password, and you'll need to enter that and change to a password that you're happy with. And then you get access to that really new, nice looking format, which we think you'll enjoy. So stay tuned for an email from us. And Ben, just to summarise, in terms of the opportunity set for investors at the moment, we haven't had much time today or even during a busy Australian reporting season to reflect on the greater opportunity set that exists in international equities, where we can find quite a number of potentially better value, higher growth stocks of real interest.
Yeah, I think, without wanting to labour the point, we've been talking about this for several years now, is that, as we look at these businesses in more detail and probably spend more time covering them, I think we both agree we're finding businesses in many cases of higher quality than we can find on our market that are trading at lower earnings multiples than, and in some cases much lower earnings multiples than we would be accustomed to paying on our market. I think, there's an element where there's so much money that is trapped in Australia because of our superannuation system and, our very healthy capital markets here. There's not a lot of really world-class growth stocks, I would argue, on our market. There's definitely some, but not as many as maybe a lot of people think. But there's a lot of money looking for them. And so, to me, what tends to happen is they can get bid up to much higher multiples than maybe much bigger capital markets would be willing to pay. And if there is a slip up or something goes wrong with some of these businesses, there's a lot further to fall as a result, because they are, sometimes trading on elevated multiples. And, I think we've been speaking, just as an example, about Amazon for several years now. When you look at
lately, haven't they? So they provided another entry point potentially.
They've come off about sort of 10%, 15% since their result. They're going potentially through a company transforming phase with Jeff Bezos stepping back and someone coming in that might be more interested in profitability than just ideas. And as we saw with Google, sort of 10 years ago, which is when things really, from a shareholder point of view, took off. So, it's maybe just something for clients to keep in the back of their minds and maybe to think about. I mean, another couple just off the top of my head, I've noticed MasterCard and Visa, which have both come off about 15% in the last month or so. Effectively, the rail tracks of the global payment industry that everything eventually goes through, and also a great way to play the reopening of venues across the United States and Europe and hopefully eventually Australia. As people get out and start tapping and going again, it's a great thing for their business, which has suffered because of lockdowns, etc. So, there's some things out there which you just can't buy on the ASX.
Yeah, so I think broad and make sure you speak to your advisor to get further details and take that forward. Well, it has been a productive time, the reporting season. It's been busy for all of us in a very different way, and we hope all of our clients and friends are well. We look forward to updating you again later in September.